IPOs can be a sure way to lose all of your money. They are the riskiest way to invest your money, yet I love investing in IPOs, and they are the reason why I'm going to retire decades earlier. In this video, I'll be telling you why it's so hard to make money with IPOs, and at the end of the video, I will be telling you my IPO investing strategy.
Is it Brian? Yes.
Hi, I'm Matt Giannino. I teach you how to make money, grow money, and invest money, so please check out my stock market course in the bio. I know you don't want to lose money, but most investors think it's a good idea to buy IPOs right when they come out in the market. But doing this will be the reason you will never be successful in investing, because of the simple fact that IPOs are a trap designed to rob precious investors of their money. At the same time, they could be the single best investment if you know when to buy and what to buy. This strategy I will be going over at the end of the video, and it may blow your mind, this IPO investing strategy. If you don't know what an IPO is, it's called an initial public offering. This is a stock that enters the stock market for the first time going public, and it's a super exciting time for investors, as it offers a chance to invest in companies that are new, exciting, have plenty of growth and future potential. These are companies you may use every day, may be excited about, but most importantly, you haven't been able to invest in them until now. These are companies like Airbnb, Lyft, and Uber, who are just going to go public in 2019 and 2020. So before this time, only a select group of investors could have ever bought stock in this company. But first, let's discuss the returns of the latest IPOs in the market. We have Chewy.com, which is down 34% from its IPO date. Lyft is down 50%. Uber is down 30%. Neo is down 80%. How could companies so early in the world with so much promise drop so hard as stock market investments? This is the exact trap I will be talking about in this video, and this is the reason why you will lose loads of money investing in these early IPOs. Because let's think about it. Uber right now is down 30% from its IPO date. How could a company with the most drivers in the world, the most ride-sharing revenue and customers, be down 30%? That doesn't make sense. It's a great company. But what if I told you that there's a 70 to 90% chance that an IPO is going to drop 30 to 50% in the first 3 months? Would that shock you? This is exactly the trap I was talking about. This is why people lose so much money on IPOs. And right now, I'm going to tell you why the stock is most likely going to drop in the first couple months. These companies like Lyft and Uber are very early companies, so they've seen their valuations go from maybe $1 million all the way up to $10 billion for Lyft and Uber. Uber right now is valued at about $40 billion. During this time, while the company is growing, you can't buy the stocks. This is what we call a private company. The only people who do have stock are employees and early investors, and those people have seen the valuations go from, like I said, $1 million all the way up to about $40 billion. So most of the people already owning the stock are profitable. They have huge gains. And these companies, it's very easy for them to increase their revenue and increase their valuation, thus having their stock price go up. But the problem is that these people, these early investors and these employees, don't have anybody to sell their shares to because there's no market that is trading their shares. It's really tough to move around shares in a private company, and it doesn't really happen often, meaning you're basically locked into your shares until the company goes public, where it's trading on the public market, the stock market. So this is exactly how they solve that one problem of not having anybody to sell their shares to. They sell their shares to you. They're going to sell their overvalued shares they made tons of money on, to you. Just a quick fact to make you feel a little bit awful about investing in IPOs. So these private companies, just the simple act of them going public or just telling the news and the media they are going to go public in the next couple years will double their valuation, meaning their company already is 2 times as expensive as it was before they were public. So when you have the ability to buy shares of that company, you're going to be buying the company when it's the most overvalued and the most expensive. You're not going to be getting a deal at all. This is where you can get ripped off as an investor. This is exactly what happened to Lyft and Uber. Their companies were valued at $6 billion for Lyft, and then we had $20 billion for Uber. And when they said they were going to go public, Lyft went went up to $12 billion, and Uber went up to almost $80 billion, meaning you're not getting these companies at a discount at all. So why should you feel confused when the stock is dropping? Because it could drop 50% just to go back to its original valuation before it was public. This also is gonna blow your mind. This is why IPOs are just so lethal to invest in the first 3 months. So when the company goes public, there's so much bullish news coming out, so many deals being made, all so that they can boost their valuation, and most importantly, just keep the stock price even flat for at least 3 to 6 months, because when those 3 to 6 months are over, we have this thing called the lockup period. And these are the worst words you can hear as an IPO investor, because that is the moment that the early employees and the early investors can finally sell their shares on the open market. So what you normally hear during this time is these early investors and employees will say that they're not going to sell their shares and they're going to hold them long term. And I'm telling you that's BS, because they have made so much money and they finally have a place to sell their shares on the open market. So when that lockup period is over, they're not going to waste any time in dumping shares into the market. And this selling pressure is why IPOs drop 30 to 50% in the first couple months, even more depending on the share float for the company. So let's think about that one more time. The first 3 months, anybody can buy the stock on the public market. A lot of news boosts the valuations and it goes crazy. After 3 to 6 months, anybody in the company can sell their shares finally. So this puts tremendous selling pressure on the stock, dropping it for multiple months at a time as shares are constantly being flooded into the market. As this happens for 6 to maybe even 8 months, the stock starts flattening out at the bottom. This is where the selling pressure is finally gone. This is the best time to invest in IPOs, and this is why I get so excited. This is my IPO investment strategy. This is what I call the golden time for IPOs, when the stock is down 50% and the selling pressure is finally gone. And during this time, you have to ask yourself 3 separate things. This will help you avoid investing in bad IPOs and, most importantly, having success long term with this strategy. So the first thing you want to do is think like a shark on Shark Tank. When you're looking at these companies, you want to understand that they have potential in the market and in the future. I talk about this strategy all the time. Just go out into the public and see if people are actually using the products and buying them every day. This is exactly what I did with Snapchat. So Snapchat was at $6 a couple months ago. Now it's at 18, so 300% return. During that time, I went all over Europe. I saw everyone using Snapchat. I came back to America, saw everybody on Snapchat. This validated that the company was being used, they had plenty of people on their platform, and it was a good investment. So that's why I bought Snapchat the last couple months. But it's so easy, and you can do this with any single product. The next step you want to do to see if it's a company that's worth investing in is check their debt and their assets. You want to make sure they're not over leveraged, because the next economic downturn can ruin companies that have way too much debt, because they won't be able to pay that. They're going to have to dilute you as the shareholder. It's just really bad news in a bad economy with these IPOs. And the third step to figure out if it's a company worth investing in is, does it have low competition? Is the company protected from a revenue standpoint? Is the barrier to entry high for the technology or the products they're making? Low competition is very important for the long-term success of this stock. If you can nail these 3 steps to finding the best IPO stock, it will help you have success long-term with this investing strategy. It will help you have more winners and less losers. But I'm not a financial advisor. This isn't financial advice. This is just something I'm excited to do in the next recession. So part 2, how you have success in my investing strategy, is you buy these stocks that met all 3 steps earlier when the market is down. During the next bear market, recession, stock market crash, when the market is at its completely low level, you want to buy at least 10 to 15 IPOs, because those companies could go up 7,000%, 10,000%. So by buying 10 or 15, you can afford a lot of losing IPOs as long as you pick the one unicorn. That's how angel investors have success, is they try to pick the one unicorn company that does well and makes up for all their bad investments. Reason number 2 why I like to invest in companies in recessions is because if they can survive recessions, they're savvy, they're smart with their money, and most importantly, they have a great product that people still buy in recessions. So if a company company can survive and thrive in that environment, those are companies I want to hold long term. And like I said, the next step to doing this is picking 10 to 15 companies. And here's the fourth step. This is the hardest step. This is the step most people will not do, is hold these companies as long as possible, because when people bought Apple at $4 and sold it at $100, I bet you they thought they were the best investors in history. They just sold a stock that made thousands of percentages of returns. But when a company really takes off, that validates that it was a success and the company does have great market share and a market hold. So when that happens, you want to hold your winners, because Apple at $100 now went up to $245 right now. Who knows when it's going to stop? That's why it's important to find the winners and hold them as long as possible. Don't try to sell them at the first sign of 100-200% win. You're going to see some really crazy returns with IPOs. This is my IPO investing strategy in a nutshell. If you want to hear the best investments this year, this will shock you. Check out the video to the right of me. Also check out my stock market trading course. You will never guess what the best investments for this year are. If you guessed the housing market, you would be wrong, returning 3% in the last 2 years. If you guessed the stock market, returning 2.6% in the last 2 years, you'd be wrong.